Hey there, welcome to Weatherwise, the podcast that turns climate headlines into everyday conversations.
Thanks for having me. I'm excited to unpack how insurance is turning disaster-prone cities into financial no-go zones.
Let's start with a staggering fact. Over a quarter of U.S. homes worth $12.7 trillion are at risk from hurricanes, wildfires, or floods.
And in those high-risk pockets, homeowners are paying up to 4% of their home's value each year just for insurance.
Imagine buying a $614,000 house in Miami and then shelling out about $23,000 a year for coverage.
That's roughly 3.7% of the property's worth, 4 times the national average of 0.8%.
New Orleans isn't far behind, with premiums hitting 3.6% on a comparable market value, PAYU.
Cape Coral follows at 2.2%, still well above the national norm.
So what's driving this spike? Climate change is making storms more frequent and intense.
Rising construction costs mean rebuilding after an event costs more, so insurers raise premiums to stay solvent.
And let's not forget the lawsuit wave in coastal states. Each claim pushes payouts higher.
In some places, companies are pulling out entirely, leaving residents with last resort plans that still cost a fortune.
California offers an interesting counterpoint.
The state's FAIR plan covers many who can't find private insurance, but new regulations could push premiums even higher.
On the flip side, Florida and Louisiana have seen some stabilization after reforms targeting fraud and litigation.
Premium growth in those states has slowed to just a few tenths of a percent this year, proof that policy changes can help.
Bottom line, buying a home in a disaster-prone area isn't just about weather risk anymore. It's also about the price tag on protection.
Homeowners need to weigh future climate threats against what they're willing or able to pay each year.
That's all for today's episode of Weatherwise.
Thanks for listening and stay safe out there.